insurance are issuing the policy on the basis of different methods of deciding the sum insured. For example, some company is using purchase value, some sales value, some market value, some book value, some depreciated value, some resale value. Number of values are provided. Since no standardized method was there, so there was no uniform practice at all. But now with the introduction of these two policies, the method or a standard method has been introduced to decide the sum insured of the policy. So these two policies were introduced from 1st April 2021 up to the sum insured of 50 crore rupees only. Over and above 50 crore rupees, still the standard fire and special peril policy will be issued, not any of these two. These are uniform to all the general insurance companies except the prices and the add-on covers. Because add-on covers are approved by the IRDA, but they are different in nature. Any company can file any number of add-on covers. Their terms, conditions, wording, prices, everything could be different. There is no uniformity at all in the add-on covers. Add-on cover means those risks which are not covered under the policy, but they can be insured on additional payment of premium. So the add-on covers are introduced. Now today, up to the sum insured of 50 crores for any commercial unit, either of these policies issued, maybe it's a case of new insurance or a renewal or a market rollover case. Because no option is there, no alternate is there. Now, since almost all the general insurance companies are working on this concept that they have introduced various package policies, keeping in mind the requirement of the commercial institutions, because they always prefer to take a policy which is providing the coverage related to all the existing risks. So a commercial entrepreneur will never prefer to take individual policy for individual risk. Instead, he will always prefer that one policy will be taken and almost all those risks are covered under the one policy. There should be a feasibility to choose the options available in the policy. So on this concept, the general insurance companies have introduced the package policies. We are also having plenty of package policies. For example, business protection policies, the shopkeeper insurance policies, the office care insurance policies, the hotel and restaurant policies, the education shield insurance policies. These are all package policies available with us. This were introduced keeping in mind the insurance requirement of different segments. Say for example, shopkeeper is a different segment, offices are different segments, educational institutions are different segments. So their requirement could be different. Number of success could also be different. When these policies are made, insured has the option to customize them according to his requirement and affordability of the deal. But the only uniform thing is that almost all the general insurance companies, when they are introducing the package policy, they are keeping the section 1 as the fire insurance. And that is almost mandatory in all the package policies of all the general insurance companies. Secondly, they can also fix up minimum number of sections to be opted, maybe 2 or maybe 3, depends, company to company. So for example, in all the policies, all the package policies, minimum 2 number of sections are compulsory. But in business protection, 3 number. So it can differ, policy to policy. Now up to the 50 crore means When you are issuing a Bharat Sukshma Udhyam Suraksha policy, sum insured cannot be even 5 crore 10 lakh. No. The maximum sum insured limit is 5 crore. The moment it is 5 crore 10 lakh or 5 crore 5 lakh or over the 5 crores, the policy, Bharat Laghu Udyam Suraksha policy will be issued. And there the maximum sum insured limit is 50 crore. This sum insured is based on the value of risk at one location. So the first concept is this policy will be according to the sum insured limit, and that sum insured limit of fire section will apply. So for you, nothing you have to do, because in the proposal form, when you are writing the sum insured, the policy will be automatically switched to the relevant one. Now, when you are issuing a fire policy, you know it can be given to any non-insured risk, it can be given to manufacturing risk, even exclusively for storage risk or utilities and tanks also. If you want to clearly understand what is non-industrial risk, in that case you have to understand that in any commercial unit where there is no turnover, no production, no output, on the contrary, the services are provided, that is known as the non-industrial risk. For example, hotel, office, shops, hospitals. A manufacturing risk is an industrial risk which is related to the production, turnover, output. A storage risk could be combined or exclusive. It could be in open, it could be in closed go down. Utilities and tanks are depend upon unit to unit. If they are available, they can be insured otherwise. So in these two policies, number of perils were increased from 12 to 14, because in previous policy, that is external fire and special perils, only 12 perils were there. Here it is 14. So the customer is benefited by 2 additional perils without any exception. There is no provision of deletion of perils. Sum insured is divided according to the product up to the 5 crore, the suit with them, and over the 5 to 50 plug with them. Compulsory access is fixed, and suit with them, that is 5,000 on each claim. But in Laghu with them, it is 5% of each claim, subject to minimum of 10,000. This compulsory access is different in case of terrorism risk, because there in terrorism risk, this is directly dealt with by the terrorism pool, so they are deciding the terms and conditions of the terrorism coverage. Minimum premium of these policies is 500 plus GST plus for SPSV and 1000 plus GST for SPSV. Now see, the fire is one risk, which is a self-sustaining process of rapid oxidation of a fuel. Any fuel which produces heat and light. So fire is one thing where 3 component works: fuel, oxygen and temperature. If that fuel sustains a temperature over and above its tolerance capacity, it can catch fire. And the moment it is coming into the contact of oxygen, which is always available above 23% in air, this situation becomes dangerous due to the increased fire hazard, because in that case the fire will spread. As far as fuel is concerned, for the purpose of fire, everything is a fuel. Maybe a solid, liquid, vapors and gases. Among solids, wood, fabric, synthetic material, packaging material, papers. It may be flammable, It may create even a spark also, or even a spontaneous ignition. They all are covered now in these two policies under the fire barrier. Because fire definition has been increased now. Earlier it was confined to the fire which is having the flames. But now the own fermentation or natural heating or spontaneous combustion are also part of the fire reaction. May there be flames or not, makes no difference. But if it is burned by fire, the rest will be paid. Similarly, the little change was made in the bushfire peril, where the forest fire and jungle fire is also included. Because normally the losses are caused by the forest fire and jungle fire. So among the 14 perils, 3 new perils were included, that is earthquake, terrorism, and theft. The definition of impact damage was also changed, because aircraft damage, which is an independent peril of the standard fire and special peril policy, has been merged here in the impact damage category in both the policies. So among the 14, the aircraft damage is not a separate peril. On the contrary, theft peril has been included. Theft, not exclusive theft, but if it is followed by any other peril, then the theft from 1 to 7 days are covered. This is important to understand. Not exclusive theft is covered. Exclusive theft cannot be the part of the fire policy because for that purpose a separate burglary policies are not there. But if there is theft followed by any other peril, and theft is taking place in pieces, in continuation, on different dates also, still the theft is coming from 1 to 7 days. Say for example, after riots, some theft has taken place. After flood, after fire, after earthquake, these are common things everywhere. And in routine, these kind of thefts are taking place. Now in these two policies, no peril can be deleted. That means all 14 perils will exist from the date of issuance of the policy till the expiry date of the policy. In between, or even at the time of issuance, or at the time of renewal, either at the option of the insured or at the option of the insurance company, none of the perils out of the 14 can be deleted. No peril can be deleted by insured or by insurer out of the total 14 perils from the day one to the expiry date. But this provision is not there in the external fire and special peril policy. That policy provides the exclusion of these two perils, which are known as RSMD and STFR. Now certain inbuilt coverages were also allowed by the IRDA, wherein the limits were increased to the existing benefits, and other inbuilt coverages were those which were the add-on covers in the standard fire and special peril policy. Still they are. So with certain limitations, they are included as inbuilt coverage of the policy, and without any extra premium they are covered now under these two policies. For example, additional alteration or extensions, temporary removal of stocks, cover for specific containers. Startup expenses, cost compared by municipal regulations. Stock on floater basis, preloaded software and stock held interest. These all are still add-on covers with the standard fire and special peril policy which covers them on a payment of additional fee. But here in these both the policies, these are part of the inbuilt coverage for that no extra payment is charged. This stock on floater basis can also be given. And there is no charge as far as the Suchmuddam Suraksha policy is concerned. But the moment the sum insured is exceeding 5 crore, 10% will be applied. Floater risk means cover for stock at multiple locations under one sum insured. Cover for stock at multiple locations means we have a textile mill in Bhilwara. I have my godowns at Udaipur, Jodhpur, Jaipur, Bharatpur. I want to insure all the 4 godowns along with my factory. But the total cost of all the 5 are less than 5 crore. There will be no extra charge to insure them under the floater basis. Sum insured will remain the one only. But multiple locations will be covered. Declaration policy is required only when there is a frequent fluctuations in the stock value. On declaration basis, it can be insured. But normally, this frequent fluctuation on stock basis comes where the product is on the demand basis either, or it is on the season basis. In seasonal products, say for example, some winter product is there. So in the winter season, the stock will go to the highest position. But in the off season, that is summer or the rainy season, demand will not be there. The stock is only lying dead. No entrepreneur would like to increase the stock in such a situation. So the frequent fluctuations will come only at the time of season. In that case, the policy can be taken on the declaration basis, not otherwise. So how the sum insured will be decided under the policy now, because it has been standardized in both the policies, and now all the general insurance companies will issue the policy on the restatement value basis for the properties. Properties means building, plant and machinery and furniture, pictures and buildings. This is a common sense in every commercial unit. Building, plant and machinery and furniture, pictures and buildings would be there. They all will be insured on the reinstatement value. But for the stock, that could be in different positions, different shapes, different stages. The value would be applicable accordingly. So for example, raw material, the landed cost will apply. The stock and process, the input cost will apply, and the finished stock is there, then the manufacturing cost will apply. In addition, if there are some precious stones or bullions or unsets in the commercial unit of that entrepreneur, those can also be insured on the agreed value basis. Agreed value means the value agreed between the insured and the insurer on the basis of the valuation certificate or on the basis of invoice. Some proofs must be there. But all the properties, that is building, plant and machinery and furniture fixtures, would be insured on the restatement value only. So now it is a pressure on you to understand what is the reinstatement value. So the reinstatement value means the value at which the building or that plant and machinery or that furniture fixture could be reinstated or replaced by a similar property. So here the deduction is not applicable. So this is the amount at which the insured property can be reinstated or replaced by the similar property. This is called reinstatement value. But this may not apply in case of sale of the items. If some stock or some quantity is sold out but it is not delivered, in that case, before delivery, if there is any loss to the goods, insurance company will pay the contract price. Contract price means the price which is charged from the customer at the time of selling. May there be any manufacturing cost of that product, that will be low. Company will pay on the basis of contract price, because the company's liability shall be based on the contract price only. Now, cover for specific contents is also there in the policy, because these are the innovative coverages known as the innovative coverages, and these are four in nature. Four are there with both the policies by all the general insurance companies for no premium charge for all these four benefits. So among the innovative coverages, there is a money risk up to 50,000, there is a document risk up to 50,000, there is computer information and data risk up to 5 lakh, and personal effect of visitor or tractors risk up to 3 lakh, that is maximum for 20 persons up to 15% per person, so total could be 3 lakhs. So the important thing to understand is these four innovative coverages are insured without charging any extra premium, and the benefit can be availed by the owner of the enterprises, because at any time there is a loss to the money. Up to 50,000 it is automatically covered. There is no requirement of taking the money in transit policy if there is any loss to the important documents or deeds or manuscripts and drawings. Up to 50,000 the insurance company will pay, or if there is any loss to the data, information, programs of the computer, in that case 5 lakh rupees. And personal effects of visitors, employees and debtors. Because you will find in commercial units normally the directors are visiting, employees have to come every day, visitors may or may not come. But if they are there, or fire occurred, flood occurred, earthquake occurred, and there is a loss to their properties, this will be covered, because the limit is fixed. 20 people, 15,000 per person. So this is innovative coverage. Now, waiver of under insurance is one more benefit which is provided by the IRDA to the policy holders. In case of any loss, insured should not suffer. That must be your effort. When you are selling the policy, your insured must be protected. At the time of loss, he should be paid for compensation also, whatever is assessed by the surveyor. But in addition to the assessment, there could be some more deductions which are applicable as per the policy classes. If there is under insurance, in case of property insurance and machinery insurance, the claim amount will be deducted in the same proportion which the insured is having the policy. Say for example, my property is worth 1 crore. I am taking the policy for 60 crore or 60 lakh only. I am paying the premium for 60 lakh only. That means my property is underinsured for 40%. If there is any loss, I am filing the claim, company will pay me the claim, but after deducting the 40% loss on account of underinsurance, that is, average clause will come into the picture. So here the IRDA has given a relief to the policyholder that if at all the underinsurance is up to 15%, we will not deduct any amount from your claims. 15% is a good percentage, because 15% means you are deliberately not disavowing the valuation on the basis of reinstatement value. But if it is more than 15%, that means you have not followed the law or rules of reinstatement value. You have not taken the standard sum insured method. Because up to 15% it can be considered. There could be fluctuation in the prices on account of the market conditions. May it be a building, a plant and machinery, or a furniture pictures. So 5%, 10%, 15% is normal. More than that, it is intentional. So under insurance up to 15% can be waived. That you can understand with an example also. For any educational institution where the policy is of 5 crore rupees, there is a loss of 1 crore rupee due to earthquake. 2 top floors suffered the shock and they fall down. Now when the claim is filed on the insurance company sent the surveyor to inspect the loss and physically verify the loss and make the assessment of loss. Now when he is giving the assessment in his report, he is also writing that the property is underinsured because the policy is for the 5 crore while the value at risk of insurable item at the time of loss is 5.5 crore. This clause is important. The value at risk of insurable item at the time of loss, if it is found underinsured, what is here like? 5.5 crore is the value while the policy belongs to 5 crore only. That means there is under insurance. Loss is 1 crore rupees. Under insurance is almost 10%. Since it is less than 15%, we will consider the full claim of 1 crore payment. So here, a great help is given by this clause to the policyholder. Because after 10, 12, 14, 15, the under insurance will be waived and nothing will be done. Here the under insurance value was 1 crore. And out of that 1 crore, 10% was underinsured. 10 crore means 10 lakh rupees. If this waiver clause was not there, the 10 lakh rupees, the amount would have been deducted from the claim of the policyholder. So that may have caused a great trouble to you because your insurance is gone. You will understand that much that you are not the person who understands the insurance very well. Since you don't know, you cannot properly guide him. Rather, you will misguide him. So instead of coming to you, he will go to some expert. If you know the under insurance we are explaining at the time of taking the policy only, that the value should be higher, not lesser. Take the value which is prevailing today, not the value which you paid at the time of purchase. So that will make the difference. There will be no under insurance if you are taking the higher value. Because giving a few thousand rupees more at the time of insurance will save the liability of lakhs of rupees and crores of rupees. So this waiver of under insurance clause is very important in the sense up to 15% waiver will be given. But in case the waiver exceeds more than 50%, then what would be the situation? Let us understand with an example. So I have electronic gadget shops. आप taken a 1210 रुपया policy, switch medium structure policy. For the building structure of 3 crore and stock 1 crore. So 4 crore policy I have taken. Suddenly there was fire and there was almost loss of 50 lakh rupees over there. So when the surveyor came, he inspected the loss, he took the photograph and he visited to the site. He personally found that the actual value of the structure was 3.5 crore at the time, the rate of loss. And the value of stock was 1.5 crore. So 3.5 and 1.5 means also should have been taken for 5 crores instead of 4 crore. All the insured have taken the policy for 3 crore structure and 1 crore stock. Policy taken for 4 crore only. Actual value is 5 crore. This is the under insurance of 20%. Here, loss is 50 lakh. Under insurance is 20%. There cannot be any waiver. Even if the insured is asking that as per the policy provision of 50% waiver, you give me the waiver of 50%, 25%, and remaining 5% you deduct. But no, this system will not apply here. Here, entire 20% will be deducted from the claim amount in case the sum insured is underinsured. And in that situation, only the policy holder would be the loser because of the fault of marketing people. So this under insurance is very important to understand, and you should not lose your customers on this ground. Now, stock held in trust is one add-on cover which has been merged in the policy without any extra premium. This situation is very critical, and this you must understand when it is required, because there are certain customers like motor vehicle garage owner or dry cleaners. They don't have their own properties in their shops. But if there is any fire or any loss due to any insured peril, the stock burnt or damaged. So the owner of that property, that stock, that item will claim the losses from the dry cleaner or the motor vehicle garage owners. Because if you are going to any dry cleaner shop, you will find that the clothes which were there for dry cleaning were none of them belonged to the owner of the shop. They were all of the customers, and customers were who? You and me. So if that entire stock is burnt, we will claim from the dry cleaner only, and the dry cleaner will be in a position to pay because the stock held in trust is covered under the Sukshmuddam and Laghuddam policies today. Similarly, additions, alterations or extensions. If during the policy period any addition, any alteration or any extension is made in the insured premises, maybe because of any reason. It may be in the building, plant and machinery or furniture fittings. And if it is intimated to the insurance company within 7 days, the risk will be covered. What the insurance company will see? The maximum addition, alteration or extension should not exceed 15% of the total value. One thing. Whatever additional amount you have incurred on that addition or alteration or extensions, that will increase the sum insured, so a difference amount of premium will be charged by the office. In such a situation, you will be out of that under insurance trouble also. And the risk is also covered, because when you took the policy, say suppose that time your sum insured was 3 crore for building. But if you have made some more floors on that building and spent 50 lakh rupees, so today your sum insured should be increased by 50 lakh rupees. Then only you will be saved from the under insurance. So these additions, alterations or extensions can be covered by intimation to the insurance company, because the endorsement will be issued and the present amount of premium will be charged. That is all. No other risk is there. So this is the scenario which is showing the difference between SBSU and SBLU. Here the difference is very light, very slight, you can say, because the sum insured is the criteria which will define which policy has to be issued, and the sum insured is restricted in the SVSU up to 5 crore and in the SVRU up to 50 crores. Compulsory access is also defined because in SVSU it is 5,000, but in SVRU it is 5% of the claim amount, that is subject to minimum 10,000 on each claim. Now floater cover is not chargeable in Sukshmadyam, but it is chargeable in Laghudyam. Startup expenses are minimum 1 lakh rupees covered in the Sukshmadyam, but up to 5 lakh covered in the Laghudyam. Minimum premium is also differs, 500 plus GST and 1000 GST. Certain other things are also important to understand, because at the request of the insured, some insured under the policy can be increased or decreased, but normally nobody will go for decrease of the sum insured, because if any alteration or addition is made, in that case sum insured will automatically increase. So that can be covered on payment of additional premium, and an endorsement can be issued. This change or alteration can be made during the currency of the policy also. So as per new policy, the compulsory access cannot be changed. Because in Sukshmadyam there is a flat compulsory access of 5,000 every claim. Even if there are 2 claims or 3 claims in an year, so in a year, on each claim, 5,000 will be deducted flat. Maximum liability of the insurance company is always restricted to the sum insured. But if there is any additional add-on cover, the liability will increase to that amount also. Because that add-on cover which was received on payment of additional premium is also covering the additional risk, and that additional risk also has the sum insured limit. To that extent, that add-on cover will provide the coverage, and the insurance company has to pay the claim. So this is add-on cover coverage. Now with the fire policy, if the loss is caused by terrorism, the limits will be different for the compulsory access. But these limits are applicable only if the loss is caused by terrorism, otherwise not. So when you are giving a fire policy to any of your customers, you also keep in your mind that we have got 8 add-on covers also. The customer don't know these add-on covers, because these are the additional coverages which are available on additional premium, so they normally ignore it. Because there will be additional premium to get any or all add-on covers. If they are taking 8 add-on covers, the premium will be charged for all 8 add-on covers. So whatever is related to them, they can select. Say for example, if any entrepreneur is running his unit which he has opened or started by taking a loan from the bank or from the finance. Now for him there is a related add-on cover that is known as the installment protection up to 50,000 per year. Here if he failed to pay 3 installments by any reason, the insurance company will cover, and the insurance company will pay up to the coverage of 3 EMIs. So that coverage is already there with the add-on cover. So Smitali ji, you have to mute yourself. Similarly, claim preparation cost, loss of rent, additional expenses of rent for an alternate accommodation. These are all 4 add-on covers which the customer can select as per his need. In addition, accidental damage cover, involuntary betterment, expenses for loss minimization, escalation clause. These are the 8 add-on covers. Escalation we normally advise to the customers, because the price fluctuation could be there even during the policy periods. So to cover the under insurance part, the customer can select certain percentage, that may be 20%, 25%. If there is any under insurance, up to that extent, there will be nothing deducted from the claim amount. Because the escalation clause will automatically cover the under insurance part. Now, stock at multiple locations is to be insured. In that case, the address of each go down with the stock value has to be mentioned in the proposal form only. Then only the protocol will be issued to covering all the stocks at different locations under one sum insured. What the primary requirement is? The address of all those locations and the value of stock in each go down. Now, who can take this policy? Normally the entrepreneur takes, but there could be different circumstances when the unit is sold. In that case, buyer will take the policy. Unit is given on lease, in that case, lessor will take the policy. Unit is given on rent, in that case, tenant will take the policy. Only in case of tenancy, there would be slight difference in the situation because the tenant cannot take the policy for the building. He has got no insurable interest in the building, so he will not be given the insurance of building for rest of the things like his plant and machinery, for furniture fixtures, for stocks, which may be belonging to him, can be covered under the policy. Now, restoration of sum insured is another important clause of the fire insurance policy because if during the policy period any claim is taken, maybe 1 or 2 or whatever it is, the sum insured will be reduced from the same amount what amount of claim is settled and paid to the insured. So that will increase the risk of the under insurance. To avoid that, the sum insured will be restored on payment of additional payment. So this restoration facility is already available with all the general insurance companies after prior settlement of claim. If claim is registered, intimated and assessed also, but it is not paid or it is repudiated, then the sum insured is not affected. If it is paid, in that case only, that from that amount, whatever amount is paid to the insured, the sum insured will be reduced. And after reduction of the sum insured, there will be the risk of under insurance. So in that case, proportionate premium is required to be paid to restore the sum insured. Now there are multiple policies which are known as the package policies. In all those policies, this fire section is covered, and in the first section, this fire risk coverage will be there, and that first section is mandatory in all these policies. So the policy will automatically convert the policy part by the software. You don't need to select it. You just have to mention the sum insured and the proposal form. This will automatically select which policy would be applicable here. Here one important aspect is that you are given everything related to the product, but still you have to refer your each and every case to the support office underwriting department for quotations, for generating the quotations as well as for issuance of the policy, because Suchvadyam and Laghudyam policies related to the commercial segment, they are not given the power to the branches to issue these policies. The branches are not authorized. Each proposal form has to be referred to the support office underwriting team. They will evaluate the proposal and will generate the quote, and thereafter, once it is agreed by the insured, the policy will be issued. So this is all about the fire policy. If you have any questions, you can ask. Any questions from your end? Anybody can ask. Okay. What point is there? You tell me. This is this slide you are talking about? Yeah, tell me. Okay, this is 12. This is 12, and this is 13. Is it okay? Sure. Flammable and all these things are no. See, I tell you, these slides I am showing to you with the purpose that what is actually the fire, because the scope of the word fire has been expanded in these two products, and the fire word is having the limited sense in the standard fire and special fire policy. So fire could be to anything, maybe a solid or a liquid or a chemical, to anything. So when we say how the fire is working, so for that purpose this 12 slide is there. And what could be the item which can be subject or susceptible to fire? In that case, the slide number 13 is there. So this is just to explain. Otherwise, these risks relating to the chemicals and to the solids, to the fuels, they are covered since beginning. There is no change at all. Okay. Yeah. Okay. Yes. He is using, for that only he is paying the rent. But by using it, he doesn't become the owner. And unless he has the ownership, he has no insurable interest. This is something like, I give you an example. Say, you have got a private car. I am using it. Does it mean I became the owner of it? Who is the owner? Whose name is there in the registration certificate. So the policy will be issued only in the name of the registered owner. Similar is the case here. If you are the owner of the property, you have given the property to me on rent, you are charging rent from me. But if I want to insure that building, I have got no interest. I cannot even change the window or the door of that building. That right I doesn't have. I am only a tenant.